It's always a good idea to have a written operating agreement for your LLC. This document protects your limited liability status, helps prevent financial and management disputes, and ensures the LLC is run the way you want and not by the state's default rules. Let's talk about a few of the most important elements to include in an operating agreement. First, your operating agreement should specify the LLC's limited liability status, assuring that courts will find your business an LLC. Make sure you also specify the rights and responsibilities of LLC members, giving your expectations for members and a framework for how the LLC will be governed. Next, include tax provisions. For accounting purposes, specify your accounting method. Fourth, list out ownership percentages. Usually, ownership percentages are in proportion to the investment in the LLC. However, LLCs are free to distribute ownership percentages as they see fit. So always specify the various ownership percentages, especially if a party has a stake out of proportion to the capital investment. Also list out distributive shares. These might correspond to the ownership percentages, but they might not, as LLCs are free to create their own distributive share plan. Whatever your plan is, make it explicit in the operating agreement. Finally, you need to specify the conditions for distributing actual profits and losses to the LLC's members. The operating agreement should specify how often profits and losses will be distributed and how much. Members might want to consider their individual tax bracket to determine the amount to be distributed and take just enough to pay for the taxes on profits.